Christian, il team di Aberdeen Solutions gestisce 38 miliardi di dollari, di cui 4 in hedge fund, con l'obiettivo di fornire ai vostri clienti istituzionali e ai network individual soluzioni di investimento personalizzate nel campo degli investimenti alternativi. Could you explain better how the use of alternative has been growing in the institutional space globally and how they are used in the portfolios?
Sure. Thanks, Stefano, and apologies for me doing this in English, but if you heard me try in Italian, you'd understand why. Since 2008, shortly after the crisis, we saw a very big fall in assets all across the hedge fund industry, but we also saw a fall in assets across all kinds of risk assets as investors look to seek liquidity and safe havens. Since that time, there has been a big return to alternative investments. We've seen assets grow from being at around 1.8 trillion at the end of 2008, growing back to around 2.25 trillion US dollars around the middle of last year. And although we hear that assets are beginning to slow down a little bit, that's still a pretty significant growth path that we've seen over that period. And I think that's a lot more than we can say for many of our economies right now. Thanks. Can you take that? Thanks. So something I think is very interesting to look at then is what have been the drivers of this growth. 10 years ago, the hedge fund industry was dominated by high net worth money, and funds of hedge funds were real drivers of growth in the assets. Today, growth is very much coming from institutional money, and the switch has changed from assets of around a third being institutional money a decade ago to probably more like 3/4 of the global AUM in hedge funds being from institutional investors now. And when I say institutional investors, we're talking about charitable foundations, public and private sector pensions, insurance companies, university endowments, family offices, and of course sovereign wealth funds. So all these kind of investors are making up a significant majority of the assets in hedge funds today. And within that group, there's a real trend towards investing in the bigger name hedge funds as well, as they look for more institutional capability and organization. They're looking for brand recognition, and also, of course, for capacity, because there are large checks being written and big investments. You need to be investing in funds that can take those kind of investments. So that means also that there's a mix changing in terms of where the strategies, which strategies are attracting the most money. There's been dramatic growth in systematic strategies, CTAs, managed futures, over the last few years, and particularly in the last kind of 12 to 24 months, relative value and fixed income in particular, relative value strategies have seen quite dramatic growth. One interesting dynamic within all of that I've been saying, when you look at the AUMs growing, is that although there's been a lot of growth in the amount of money going into the hedge fund industry, the actual number of funds has fallen during that period. And this is really because, unlike, say, in other areas of the financial services industry, particularly in banking, where we see policy action and central banks basically bailing out and helping terminally ill companies that really shouldn't survive, the hedge fund industry has been far more Darwinian, and there's a real evolution and survival of the fittest. And if a fund isn't performing or it isn't offering what investors want, they will redeem, and the funds and the firms will disappear. And this has been a good thing for investors, in my opinion, because the poor performers disappear, and those that remain are trying harder to give investors what they want through performance, through improved transparency, through better fee deals, and through better liquidity. And I think investors have a lot more power now than they did have 5 or 10 years ago. So how are institutions using these allocations? Another big thing that we've seen in terms of the development of institutional investors is that they are becoming more sophisticated in the way that they allocate in their portfolios. They're using the tools available in more scientific ways and trying to understand ways of getting the profile of returns that are appropriate to their objectives, and realizing that it's more than just switching between equities and bonds to get there. There are other tools available, and hedge funds and other alternative investments allow them to do that. And this more holistic approach, looking at the big picture of what people are trying to achieve with their portfolios, is a trend that we at Aberdeen are very supportive of, and we think is very much the future future of how institutional investment is moving and should be over the longer term. And the way that institutions can achieve this is by partnering with specialists who can help them identifying the best ways of building out their portfolio, designing solutions for them, implementing those solutions, and perhaps more importantly then continuing to monitor them and actively manage them to ensure that the positions that you put in place and the investments that you have in your portfolio remain relevant to the environment that you're in and relevant to the objectives that you're trying to achieve. So I think in conclusion, I'd just say that, we're very supportive of the way that the industry is moving and the way that institutional investors can get better returns out of their portfolios by using these tools more effectively. Basically, we think that it will lead to better quality, risk-adjusted returns for institutional investors. I'll hand you back to Stefano.